Welcome to the second quarter investment commentary from me, Karl Frank at ANI Wealth Management. Thank you so much for joining me. We had a little technical snafu, so we're recording this a second time. For those of you who are trying to join online earlier today, I apologize. Hopefully we'll get this recording to you right away. I appreciate your patience. I want to remind everybody that we offer a second opinion service to you and your family for free. So you'll see this barcode at the end of today's presentation, and I encourage you to scan it and send any friends or family members you might have who might be having some questions about the market or investing or just their overall financial plan. And we'll be glad to take care of them for free of charge. We'll give them up to 3 meetings free of charge, and I encourage you to take advantage of that. It's a great service we offer. Well, without further ado, let's dive right into it. What a first half of 2025. That was really different and actually completely predictable. And what do I mean by that? Gary Wu, one of our investment managers, says, just a few weeks into the second quarter amidst Liberation Day panic, it was difficult to imagine the S&P 500 would be hitting new highs by June's end, yet here we are. In a quarter dominated by mounting policy, geopolitical, and macroeconomic uncertainty, the bulls prevailed. Equity markets seemed to reflect expectations for continued growth. Recession fears significantly diminished versus just a few months ago. Tariff concerns have lessened, and renewed confidence in pro-growth policies like tax cuts and deregulation has further bolstered equities, even as the list of potential worries has grown. Thank you, Gary. That concludes today's presentation. That is the summary of the first half of this year. If you'd like more details, I'll continue. But what an amazing first half of the year. We ended very average. U.S. stocks, S&P 500 rebounded strongly in the second quarter, gaining nearly 11% on the back of continued earnings strength in the technology and communication sectors. The tech-heavy Russell 1000 Growth Index posted even stronger returns, gaining nearly 18%, lifted by optimism around AI investment themes. Smaller cap stocks, the Russell 2000 Index, also moved higher, gaining 8.5%. International stocks, the MSCI EAFE Index, continued the run of solid performance for the year, rising nearly 12% in Q2, lifting its year-to-date return to almost 20%. International stocks have benefited from a decline in the US dollar index, which is down nearly 11% for the year. Emerging stocks also benefited. Emerging markets are up 6% in the second quarter, bringing it to 15.3% year-to-date. Investment-grade bonds, Bloomberg Aggregate Index, delivered moderate gains in the second quarter, rising 1.2%. 10-year Treasury yields ended the second quarter largely unchanged at 4.2%, but that masked massive intra-quarter declines from 4% to 4.5% range. Lower quality yield bonds finished the quarter up 3.57% as investors' appetite for risk returned. Once again, at halftime for 2025, it's an average year. S&P 500 is up 5.5%, and various components of the S&P 500 are up significantly more than that, and some of them even down year to date. This 5.5% is about half of what the S&P 500 has delivered on an annualized basis for decades, 11% per year on average, and it's there halfway through the year. So it's average. So the less you look, the better you feel. It's never been more true than today. So what if you did invest today? What if you invested at all-time highs? Well, on the top right-hand corner of the line graph you're looking at here, you're going to see a big dip, and you're going to see that's what happened year to date on delivering the average annualized rate of return like it has for the first 6 months of the year. There was a big, scary moment in time, and you did good by not panicking out, because had you panicked out earlier, you might not have gotten back in. It would have been very hard, as I'll show you next, recover the losses that you would have locked in by panicking out. What do I mean by that? Well, there's always reasons to sell. On this chart here, you'll see basically my career since graduating high school in 1991. You'll see there's been a huge number of reasons to sell the market. The font might be small, but on your screen, I hope you can enlarge it and read them. You'll remember a number of these, like the dot-com crisis, like the great financial crisis, like the COVID crisis, and perhaps you still remember 2 years after that in 2022, an inflation and interest rate spike crisis. And of course, this year is no exception to that. We had a big decline. It just didn't last so long. So if you sneezed, you missed it. What happened? Corrections are loud and recessions are quiet. On February 19th, the S&P 500 hit its all-time high. 48 days later, on April 8th, it had dropped 18.9% from 6144 to a closing basis of 5,062. And during the day, it had dropped over 20%. And it fell maybe on tariffs, trade wars, and recession fears. Yet look what happened by the end of the quarter. It had risen from 5,062 all the way up to 6,204. That's a 24.5% increase by the end of the quarter in such a very short period of time. It took only 83 days to recover that bottom. Wow. So here we are back at average. It's just an average year. The market declines like this a little bit more dramatically in 2025 than in years past. But as we're about to show you, it's not that uncommon for the market to behave like this. So don't panic out. It can be very, very expensive, and it'd be really hard to find any sort of investment where you could gain 24.5% in 83 days. You'll never know in advance when that's going to happen. We have to be persistent and talk to your financial planner about what's going on and whether what's going on in the real world really does affect you and your unique situation and financial plan. Because this is really common. Here's the list. That first row is the one I just talked about in February 19th of 2025. But the year before, July 16th of the year before, it dropped 8.5% on recession fears. Fed was behind the curve. The Nikkei crash. Look down that list. It crashes often. That's way to delivering a very high annualized average rate of return. This goes back to May of 2015. The Greece default, China stock crash, emerging market currencies, falling oil, North Korea, all sorts of reasons to be panicked back then. Here, we're going to go back to 2009. This is basically the inception date of the registered investment advisor firm who's talking to you now. Prior to that, we'd been with a broker dealer. But this is the way the world works. The market crashes often, and the recessions don't happen nearly as often as they're predicted. But the stock market corrections do, and they're very loud, and the recoveries happen quickly, and they happen fast, and they bring back bigger gains than there were losses, just like happened between February and April of 2025. So the long-term power of the markets is a package deal. You don't get the big returns without the temporary big declines. Just like happened in 2025, the market declined pretty dramatically for a short period of time and then rallied back. In fact, on the chart you're looking at here, again, back to about the year I graduated high school, you're going to see that the market's had a number of stock market crashes, but just since 2020, which is the past 25 years, 10 years shorter than even this chart shows, you've had 7 major market crashes. We just lived through one. You remember the interest rate one perhaps in 2022. You might remember something called COVID, right? It was terrifying. 3 crashes in 5 years. This is more than usual. Not too long before that, you may or may not remember the Euro crisis, when everybody thought that countries like Greece and Italy and Spain were going to bring down the entire world. Not too many years in between there. In 2018, there was a crisis over the first tariff talks with Trump. There was a pre-Christmas crash when on Boxing Day, the day after Christmas, Trump had to promise that he wasn't going to fire Jerome Powell. Ring a bell? Some of those rumors are happening now. And of course, right before then was the COVID or the dot-com crash and the financial crisis. I mean, you've lived through more crises than you can shake a stick at. And those are 7 huge ones. The average decline of those 7 since 2020, the decline now was over 30%. More than a third of the capital was temporarily wiped out. Between 2020 and 2025, equity market increased 6 times. Every $100 became $600. And during that period of time, riding through all those 30% declines, that's what earned that great rate of return. It's a package deal. You don't get the good returns without the temporary scary crises happening. So what's in our control? Well, our response to it. Inflation is one of the things that's driving the market today. We have a choice to make how we're going to invest to stay ahead of inflation. Here on this chart, you're going to see some research from IM Global Partners, and they're dividing inflation into 3 things: non-durable goods, durable goods, and services. And the argument that they're making is that from a structural perspective, inflation remains under control. Viewing the components of inflation, the only area of concern is services, particularly shelter. We'll talk about that at greater length today. In contrast, both durable and non-durable goods have been flat to deflationary since 2022. That might be something that might not make the news. The vast majority of inflation, if you feel it, happened during COVID, happened during the interest rate spike, and it's been flat since then. While tariffs may temporarily push inflation higher, the Fed is likely to look through these shorter-term effects and focus on the underlying structural picture, which we think, IM Global Partners thinks, remains benign. So we've got low inflation on this chart here at the time of printing. It was 2.3%. As of yesterday's latest result, it rose to 2.7%. Depending on your news source, that's a really dramatic increase, or it was exactly what economists were predicting. I think a theme for today's presentation will be your news source is determining your perspective, and it's worth having another perspective because the underlying numbers that we're going to look at today are not nearly as bad as maybe the news makes them out to be. On the bottom, you'll see the federal funds rate, and it's been flat at about 4.5%, and it's predicted to go down. More on that in a minute. Housing prices and mortgage rates, these are a primary concern for Americans today. Housing prices have never been higher. The average price of a used house is $423,000. The average price of a new home is $426,000. That's a very high price, and interest rates are high by relatively recent perspective at 6.7% as of the time of printing and 5.8, about a percent less if you can afford a 15-year mortgage. That's a problem. And that might be one of the stressors. And we'll come back to that at the end because the question we're going to be asking is, well, if everything is looking okay to good, why do we feel so stressed out? Here's the Federal Reserve dot plot and what it's predicting over the years by the men and women of the Federal Reserve who have the choice to lower interest rates, who vote on this, is that interest rates will be declining. So you can see the dots out there, the average of other voters, and they're saying in about a year, it should be from 4.5 all the way down to 3.875, and about a year after that, down to 3.6, and about a year after that, down to 3.3 or 3.4, and after that, all the way down to 3%. In other words, it's a 1.5% decline they're forecasting. That would help mortgage rates. That would help companies that want to borrow money. That would help people with credit card rates, right? That helps all sorts of things. It's a big boon. It's good news behind the scenes for the economy today. Interest rates are forecast still to be declining. The big news since the last quarterly update is the big, beautiful bill. Congress actually took action. Seems hard to believe, but they did, and they passed some things. We're going to have a commentary on this from an expert in August, on August 12th, the same time, 11:30, so Mountain Time. So please join us then. Ask your questions then. Rob Benson is an expert who teaches other CPAs and tax preparers all around Colorado. So he'll talk about it at that point. Please join us. In the meantime, 4 big takeaways for you. One, the 2017 tax cuts are now permanent, so your rates won't be changing. The brackets will be indexed to inflation, so you'll find yourself the same income in the same or a lower tax bracket in the future. So by and large, this is good news for our clients. The second thing is if you're 65 or up, you get an additional bonus deduction of $6,000 per person that reduces your taxes if you're age 65 or up. There was a confusing email sent out by the Social Security Administration. Rob will disabuse any of us of any misinformation we may have received because it's a $6,000 per person tax deduction, which effectively might eliminate taxes on Social Security, but it's not the same thing as what a lot of people made that out to be. The third big benefit is the state and gift tax exemption. And so per person, it's $15 million. If you have less than that per person and twice that for a married couple, then you don't have to worry about your inheritors paying any sort of a state tax. And so that eliminates that tax on about 99% of Americans. So that's also good news. The bad news, of course, with everything is the deficit. It's not declining to be forecast. It might actually increase. So that's the downside of the big, beautiful bill. It did pass and expenses have not declined. All right, now we're going to look forward. We're going to look forward to some of the predictions. This is a company with whom we do a lot of business. They have very detailed slides. They're excellent slides. A lot of these slides are only through the end of March. But the accuracy of the themes that they're talking about here are not just shared by this company, they're also shared by other investment companies with whom we are managing your assets. And there's something that's much longer lasting than just 3 months. So I chose to use these slides and share with you some big themes and some big reasons for optimism, because again, the news might make it seem like north rim of the Grand Canyon and it's on fire and everything's falling apart. It's a hellscape, is what the Wall Street Journal called that. But that's not exactly what's going on with our investments and the companies we're invested in. Things are normal to good. But here's some signs of good news and optimism. The first is markets are continuing to broaden, meaning that not just the biggest companies are getting bigger, the smaller companies, the middle-sized companies in America are also doing well. Their stock prices are increasing. And so that's very good news for us. The second thing is the tariffs. We've had a lot of time to digest tariffs. And so we're going through another tariff scare at the time of recording. But the market is much more subdued than the first time this happened. And here are four big reasons that Capital Group associates with the reason for the tariffs. In the top left, it's decoupling, and this just means moving away from China. We've depended on China for decades, and now it's time to leave them, has decided the government. And it sounds like a good number of Americans are in agreement with that. So that has a big impact on the companies who do business with China, and it's a long-lasting change. It does seem like this is a fundamental change in the way business will be done in the future. The second one on the top right is rebalancing, into the fact that the matter that you care about whether the federal government is being ripped off by other governments around the world who are charging larger tariffs than America is charging on them, you might actually like rebalancing because it's going to bring back into balance the amount of tariffs that are charged here and charged there. At least that is one of the goals for these new tariffs. The bottom right is that it brings in more funding, so it pays more for the federal government. And indeed, in the first half of the year, the government brought in more money from tariffs than it did prior to that, of course, because tariffs were really low prior to that. And then finally, the bottom left, and this is my opinion, not necessarily this company's opinion, but mine, that negotiating is the primary reason for the tariffs, that the administration is using leverage to change up things. And so that is going to continue. It's happening right now. Tariffs are on again, off again, sometimes within the same day. And so these are four big reasons for the tariffs. But if you can take a step back, maybe you won't be as worried about them as the news might make it seem, because these surprising moves that are being made that seem like they have big, long-lasting effects might not be that surprising if you can put it into one of these categories and think about them as to whether or not that's a long-lasting change, a big change, or not. So perspective goes a long ways, and I like the way that they divided it into four big reasons that the administration has suddenly added tariffs to the situation we're in. Another reason for good news is cash. There's a lot of cash. Companies have a lot of cash. Investors have a lot of cash sitting on the sidelines. And as the chart on the left-hand side shows you, shortly after we reach all-time highs in cash, the market hits a bottom and rebounds, and that is what's happening now. We've hit all-time highs, and like we just talked about, the market since April 8th has rebounded quickly, and year to date, it's at all-time highs or near them, depending on which day you look at this recording. And on the right-hand side, you can see the big blue bars show that the average annualized rate of return after we hit a mountain of cash like we're having right now is higher than at other periods of time. So this is another bullish signal. There's reasons for optimism in the equity market. Another reason for optimism that Capital Group likes is that dividends are becoming more relevant. Over a long period of time, 100 years or more, dividends comprise 36% of your income. Your total return on a portfolio of equities is determined by the dividends that they paid you, the yield. And in recent history, that hasn't been the case. For decades, it's been lower than that. But dividends are coming back. Companies have cash, they're paying them out in dividends, and that could help, especially retirees who are looking for income. In fact, if you want income of more than 3%, you can get it in large part outside the US. So diversification outside of US companies can be a very, very effective way for you to grow your portfolio. And you can see here that in America, there are about 118 companies paying bigger than a 3% dividend, and outside international, there are 315, but emerging markets is another 496. And I wouldn't be surprised by the time this recording hits the airwaves on YouTube that there are even more companies. So dividends are going up and international investing looks attractive. Companies have rising free cash flow. That's a specific accounting phrase, which basically means the amount of cash coming in is greater than the amount of cash leaving. And so companies have to do something with that. And so what a lot of them are doing, like I just said, was paying dividends. But another thing they're doing is that's the big light blue slice on the left-hand side, is they're doing share buybacks. That increases the share price of your equity. So you're not only getting bigger and bigger income, you're getting bigger and bigger share increases through what the companies are doing with their free cash flow. That's good news. On the right-hand side, you'll see another interesting piece of information is that technology companies who used to be known for never paying a dividend, are increasing the dividends that they are paying and adding more dividends to what they do for their investors. And so that's the blue slice on the right. And so that's also good news for investors. Be diverse, have a little bit in each sector, but by and large, you've got an opportunity here to get more income and possibly more equity growth as well from the companies that you're investing in. Capital expenditures are increasing across the US. These little blue dots all across the map of the United States in large part show a large amount of spending. So another thing that companies are doing, and the big beautiful bill helped incentivize this as well, is to spend money in America. Onshoring and nearshoring, bringing money back is already happening in this calendar year. And that is a trend that Capital Group thinks will continue. In fact, on the right-hand side here, you'll see that nice little green upward arrow. That's $1.4 trillion that Capital Group expects to be spent in the very near future by companies on companies to build things that companies use. So that money's going to go somewhere. It's going to be spent on something. And the equities that are recipients of this money are likely to have higher earnings and growth. So this is a good thing. This is good news. A lot of these changes are investment opportunities, and they're happening right in front of our eyes, regardless of what we see and hear all the time. There's a lot of reasons for optimism. Continuing the theme from before, small cap companies look good. We've talked about this for many investment commentaries over quite a long period of time, and you can see the Capital Group is arguing that they're still a bargain. And the right-hand side, these big blue charts are the expected earnings growth for small companies versus the little gray bars, which are the expected earning growth big companies. And so where would you rather have your money? In a company that's really profitable and getting more profitable and growing their profits faster, or a really big company that's profitable but growing their earnings slower? The answer is up to you, but and me and your investment advisors, but likely you want a little bit in both. Because if you can grow a little bit faster, and it looks like there's potential here, you might want to have a little bit more in the smaller companies. Certainly that's what we're investing with. Capital Group also likes international investing, and they've been around for nearly 100 years, since 1931, and they say they've seen this movie before, because right now we're coming off a period of time when U.S. equities have done significantly better than international equities. And it's at an extreme, and you can see it's at not just an extreme, but the most extreme it's ever been coming into this calendar year. And look what equities have done. International has started to outperform from that extreme. And over periods of time, the right-hand box shows some big percentages of how much they outperform compared to U.S. equities in periods of extremes like we're going through right now happen. And so patience and diversification can be well rewarded. And that's certainly the theme that this company, as well as many others in our portfolio, are investing with. Another slide to say the same thing is that international companies are still inexpensive. Their return on equity is lower, but growing. It's changing right now compared to US companies. And that trend could be heading right in the right direction for all of us who have a little bit of money outside the US. So good news from that company. Finally, the last one just makes a lot of common sense. And this is a very long-term chart. And you can see periods of time when the US dollar is rising. And during those periods of time, international equity investments compared to US investments are declining. And so there's some big negative red or purple numbers at the bottom of the screen there during periods of time when the dollar is rising. But at the very beginning of today's presentation, I said that the dollar has declined 11% through the end of June 30, and that's a big decline. That's a big, dramatic decline. And during periods of dollar declining, equity markets reverse, and international significantly outperforms US. And so that might be what we're seeing now. And so you'll see those big positive numbers there are periods of time when international looks favorable compared to US investing. And so that trend, it may be continuing. And when it does, it's a big trend. It lasts for a long time, and it's something you can invest with. So says Capital Group, and so says our other research managers like Iron Global Partner. Finally, wrapping up Capital Group, we need to be a little bit humble. We never know who the biggest companies are going to be. In 1980, the largest company in the world was IBM, followed by Exxon. 10 years later, Japan was leading the way, and Exxon was still there, but IBM would be leaving. In fact, by 2000, the dot-com bust is over, bubble happens, and a lot of technology companies are in there, but a lot of new companies are there. In fact, by 2010, China is a theme. And so you see a lot of Chinese flags. And by 2020, it's becoming an American economy again. It's becoming an America world GDP that depends on American companies. And last year, all 10 companies were American that were the biggest in the world. And we're entering 2025 like that. But you never would have known. You never would have known that after 30 or 40 years of dominance, that Exxon, look in the middle there, and you'll see Exxon in 2010 having that in 2010, you'd say, wow, Exxon's always been dominant. It's going to do great. But then its average annualized return over the next decade would be a minus 2% per year. So if you bet on what just happened, you're likely to be sorry. Instead, you're going to be rewarded by being diverse, by being humble, and having a little bit of money in all sorts of different companies, because some of these annualized rates of return are astronomical, and some of them, like that, are really underwhelming. So Capital Group is very optimistic. I take two steps back and ask, well, if that's the case, and all these investment themes are happening, and lots of other companies are invested this way, and our portfolios are taking advantage of these themes and being humble and being diverse and looking for ways to invest, why don't people feel good? And so we looked to a company called BlackRock, one of the biggest in the world. And BlackRock has some great complicated charts. And the first chart is to show you what I've found and what you might feel yourself. The consumer confidence has cratered. And often after consumers feel awful, the market does really well. And you can see that where we were at just a month ago was about as low as we have ever been since 1971. Feeling absolutely terrible and lacking confidence completely. And it rose just a little bit, perhaps in the wake of the market rising a little bit. And all these positive blue numbers are showing you, hey, the equity markets tend to do really well when consumers feel really bad. Why are we feeling bad? Why are we feeling bad? Well, one of them might be GDP, right? Gross domestic product. How's our economy doing? Is it doing really bad? Is it doing really well? Well, this chart only goes through the first quarter. It takes a few months for them to figure out what happened in the second quarter. But as of the end of the first quarter, you can see that the GDP was slowing, and it slowed pretty dramatically. It went negative, in fact, compared to how it had done it before. But part of that is because American companies bought a huge amount of goods overseas before the tariffs hit. And so it was a massive negative impact on the numbers that you see are minus 2.5. And then another thing that happened was Doge. Doge is actually in here. You can see that Doge reduced government spending by 0.1%. And residential, people aren't buying as much houses. It's many houses. They're spending as much money on housing as we have before, with all the reasons we talked about before. So yes, indeed, maybe that's what it is. Maybe people are worried about the economy because the GDP number came in low. It doesn't seem like things are doing as well. That could be. That could be. Economic growth, however, is right on par. It's right on the average annualized of 2.1% per year. This is the average. That's the dotted line. 68% of what comprises it is the consumer. So we're going to focus on the consumer. Maybe it's just the consumers who are feeling bad, because these companies, of course, they made a good, prudent, long-term decision to buy as much stuff before the stuff gets more expensive that they're going to buy before the tariffs hit. But what about consumers? Are they feeling bad? Are their finances a wreck? Well, look at the big blue chart on the left, and you'll see that 40 some odd percent of everything we own is our financial assets. And the second biggest portion of our assets are our homes. 27% of Americans across the whole country have their 27% of their assets tied up in their home value. So those numbers are big because the debt's the next teeny tiny little bar, and you can see that's very small. And what we'll find there is perhaps a sign of weakness. Perhaps this is what people are worried about. They're not paying back their debts as well as they used to. During the COVID crisis, we were given trillions of dollars. Americans were able to pay off their debts, and you can see that line graph going down to the right as debts were being paid off. And all of a sudden, things have spiked. And the biggest single spike there is that orange line, and it shows that student loan debt. All of a sudden, we had to pay back the loans that we made to get the education that we got, and people are defaulting at 8 some odd percent. And other debt is also starting to rise. We're starting to have defaults on car loans. We're starting to have more defaults on credit cards. And we're starting to have a modest increase on mortgages. But again, look at the numbers themselves, and you'll see on average, we're coming back to the average. We're not in a terrible situation here. All of these lines had a great few years when Americans got a lot of money from the federal government. They were able to afford everything, pay off their debts. Now they're coming back to the average. So maybe that's what's going on. Maybe not. Maybe this is just people getting back to normal, saying, oh, I'm not going to get a free ride forever. Is that what's driving consumer negativity right now? How about labor? Maybe people are losing jobs. Well, you'll see in this chart in the top right-hand corner that the vast majority of the growth in labor in last year came from immigrants. And of course, this year immigration is completely stopped or very close to it. And so you're not going to get that growth in the labor supply. But the most recent labor number showing how many people are being hired came in about average. It came in about what it always has been. The payroll gain is about 139 and the average is about 135. So it's really right average labor right now. So the bottom right chart says a lot. The bottom right chart on the left-hand side, that little gray bar says that out of everybody who lives in America, 62% of us are working between 62 and 63. Out of the right-hand side will show you that out of all of the people who between the ages of 18 and 64, what they consider the working ages, it's never been higher, the number of people who are working. It's over 77%, almost 78% of people aged between 18 and 64 are actually employed. And so it's not the labor, is it? It doesn't seem like it because people are actually employed. And it might also be shocking to you to flip the table on that and say, wait a minute, you mean out of all Americans, only 62 to 63% of them are actually working? And the answer is yes. For every one person retired, there's less than two people working. For every one person who depends on people working, there's less than two people to pay for that. For every person who's working, they've got a couple people to pay for. And so that's a situation that we've been in for a long time. But as the baby boomers continue to retire, that's a situation that's not likely to change. In any event, right now, at this exact moment, I don't know if that's what's driving people crazy. It's the labor supply. We hear negative news about it, but it's not that bad. And it's not that dissimilar from many, many years in the past. Well, it must be the tariffs. And certainly not long ago, the proposed tariffs were the highest in American history, the highest ever. And they were cut down and delayed. And now the proposed tariffs at the time of me speaking are about the highest they've ever been since 1930s. And so it must be the tariffs, right? The tariffs don't directly affect us, but we're afraid that they will because all the numbers we've looked at have shown that tariffs actually haven't yet had an effect. Maybe that's what it is. Maybe everybody's worried that the tariffs will affect us and that that's what's going on. Well, how the tariffs remember, one of the reasons for the tariffs is to help shore up the federal finances. Maybe that's what people are worried about. Maybe it's the federal finances. It's such a wreck. On the left-hand side, you can see the components of how the federal government spends its money. It's about $7 trillion a year. That's 7 million millionaires net worth being spent every year by the federal government. And you can see that they're outspending themselves by 27%. And it's actually worse than that. But if they spent $1, they're only bringing in 73 cents of income. If you spent $73 or you spent $100 and only had $73 of income and racked up $27 worth of debt, you'd be in trouble real quick. Rules are different for the federal government because they can print an unlimited amount of dollars and inflate their way out of this problem. Indeed, we've seen that really recently. But that's the situation. Maybe people are really upset about the federal deficit. Maybe that's why everybody's really worried because the money just continues to be spent and spent and spent. And like I mentioned earlier with the big, beautiful bill, that does not decrease the deficit. You'll see on the top right-hand corner that the deficit is forecast to increase. In the bottom right-hand corner, the deficit is forced to increase as well, expected to increase. And so maybe that's what people worry about. Maybe they just have an esoteric fear that the federal government won't be able to pay this debt, that the chicken's going to come back to roost at some point in time. Mixed bag. Maybe people are worried about the S&P 500 because as we've been talking about for many quarters now, the majority of the gains are happening at the biggest companies until this year. So the majority of the money being earned by all 500 companies is being earned by the top 10 companies. In fact, 32 cents on every dollar that comes into all 500 companies goes into the pockets of only 10 companies. 38% of the capitalization, meaning all the values of all 500 companies, are locked into the top 10 companies. And that's not healthy. Like we talked about at the beginning of the capital group slides, the market's beginning to broaden. And so the growth in those companies are slowing down compared to the growth in other companies, smaller companies in particular. And so maybe things are getting back to normal. We'll never know, except in hindsight. But certainly a diversification helps. It certainly helps smooth out the ride, makes this a lot easier. And it just makes common sense that you have a better potential for growth if you're not already the biggest by far. So here's maybe the bottom line for everything we've been talking about. Consumers are worried, but why? because it's actually an average year. And so thank you for not panicking. On the right-hand side, you'll see this year's annual rate of returns, the gray bar, it's just over 5%. And you can see on the way to getting here, we lost 19%. So during that 48 days or whatever that was that ended on April 8th, the market declined precipitously, and then it rallied back over 24%. And you can see that on an average year, it declines about 15% on the way to giving you the average of those gray bars, which is 11%. And you can see these gray bars can be huge. These are very big numbers that pop into there. And every now and then, maybe every 4 years, is a negative bar. Sometimes those negative bars are really dramatic, like in those big financial crashes that I was talking about before. We've had 7 of them since 2020. During that period of time, that same 25 years, the market's grown 6 times what it was back then. And so it's been a really different ride if you're paying attention on a daily basis than it is if you just look once a year or even 6 months like we are right now. Because time is on our side. What we have here is the average year could increase up to 52% or decline 37% in a single year. But if you wait 5 years, if you only looked every 5 years, you're going to have an average annual return of as high as 29% and as low as 2%. About 10 years, and you'll see your average annual return could be as high as 20% or as low as 1%. And you go out 20 years, there's never been a negative 20-year period of time that hasn't delivered at least a 6% annualized rate of return in your equities and as high as an 18% annualized rate of return on your equities. You can see what you have in front of you is a greater than sign. Draw a line from the top left-hand corner down to the middle on the right, and then from the middle on the right down to the bottom left-hand corner. And the longer you wait, the greater your returns. You see your equities are greater than you think they are. They're delivering returns and reducing the risks over your lifetime better than the other asset classes. So be patient, be diversified, be humble. My favorite slide, perhaps, of the whole presentation is always the end, and this is where I give it to our research partners at Athena, because they take all of these complicated things and they boil it down to a dashboard. And you can visit their website, athenainvest.com, and see this dashboard. As of May 2025, when I click the print button on this screen, they divided it into 4 categories, and it looks good to normal. Beginning on the left-hand side, their patented behavioral investment process says things are pretty good. In fact, investors, by and large, are in a healthy position. There's caution on U.S. large cap companies, but the smaller cap companies and the international companies are looking really good. That aligns with the other investment companies I just talked about. The second box, economic, and these are the 2 indicators that Athena has said has academic research behind it that says it has some predictive value, and you can see they're both normal. So that would be a yellow sign in your stop sign, maybe an orangish sign there for service activity for the reasons we talked about before, but goods look good. The third category, valuation, says that it's a little bit of a warning sign because stocks have maybe, perhaps, as a chance, gotten ahead of themselves. And that's certainly the case with some of these larger cap companies, which are determining 38% of the returns for the S&P 500. You're paying upwards of 30 times the price for every $1 of earnings, where some of the lower value companies, maybe you're paying $10 for the same $1 of earnings. Certainly you won't know who's going to deliver better in the future, but you've got a pretty good chance that the value companies are part of your portfolio will deliver a good return for you. You don't just want to bet on the most expensive out there. So there's some warning signs there for the biggest companies, less warning signs for the smaller companies. And then finally, on the right-hand side, the technical indicators are back in the positive. So if you paid attention in the past, you would have seen that the market hasn't had a recovery. We just went through one. And so we just had that 48-day decline, and the market blew off some steam and now it rallied back. And so that's a good, strong sign that what's happened in the recent past might continue. All right, well, in conclusion, I appreciate you hanging with me. It's a normal year, as crazy as it seems, and the news might make it look like a really bad situation, but the equity markets, the underlying economy, the companies that we're invested in, like always, are focused on making money for their shareholders. And just like them, we are focused on making money for our investors. So thank you for your patience with us. If you have any friends or family that are sharing with you any of their concerns, please introduce them to us. You can scan the barcode that you see on your screen. It opens up a web page, and you can just send them that link to the web page, and they can learn a little bit about ANI Wealth Management. And we offer up to 3 meetings free of charge. We look forward to meeting with you and your friends and family. Until we see each other again, create a beautiful day.